What is going on, everyone? Happy Wednesday, and welcome back to Sin City Crypto Live. My name is David. I'll be one of your co-hosts. And today, like every day, we're coming at you from our studio here in Las Vegas, Nevada with our daily live show. Today, big day as the FOMC meeting concludes day 2. Jerome Powell will give a speech in about 1 hour. We will have all the coverage you need, a full breakdown of FOMC, their members, their voting rights, what their policy stance is, what should we expect going into next year, and much, much more. But before we can talk about all that, I have to introduce you to your other co-host, Big Rob. What's up?
Hola! It's your boy, Big Rob, back in the house. Welcome to Sin City Crypto. If it's your first time checking us out, we're an entertainment-focused cryptocurrency channel where we take the old, the boring, the stale information, we package it up in a fun and sexy way. Also, here at Sin City Crypto, we don't just do live streams. We are also active on social media, and we do deep dives, and we got a pretty cool street interviews. We have one that just posted... what was that, a couple days ago?
Monday.
The Halloween special. So make sure you go check that out if you haven't seen it. And big day today, man. Super excited. Fed meeting coming out, or Fed meeting right now. The new rate hike will be coming out today. We're all in expectation at 75 basis points. But before we get into that, let's get into a roll call. All right. So first in the chat today, Robert Salazar. Round of applause for you, Robert. You are now my new favorite for today. We got Broke Yoshi Blake. We got Jay Delano. We got Vegas Free Baller, Liquidated Shorts, Sean Burns Jr., Redman, Yazin Breakfast. We got Nate Williams. Hola! Welcome to Sin City Crypto. We got David's Better Half. I wonder if that's, is that somebody you know, David?
I don't know.
All right, and then we got Luis, also Jimmy, Atomic Adam, Big Chili Willy, Enzo, Sir Babe, Kirt Cats, David O, and then we got Delma, Alexander, Skeezy, and David's True Love. And so for, I think Alexander and Skeezy, they've been here before. Anyways, and George O'Neillis. But if you're new here, Peter Prevost. Hola! Welcome to Sin City Crypto. Man, we're gonna break some records today. We are gonna break some records today, and call. You know what? Coca-Cola. That's it right there. So Coca-Cola.
I want to start.
There's no H in the Ola, by the way.
I want to start today's show with some comedy. So, did you see this White House tweet today?
No, hold on. One second. Just give me 1 second. I just need to talk to the viewers here. Okay. First of all, I forgot my thumbs up sign in the back in the garage because I was applying more glue.
No, just don't.
We need the sign.
We don't need the sign.
We need the sign. It's on the floor in the garage. I was spray painting it. So, I need to talk to the viewers here, okay? We need to connect. I am the captain now, okay? So, pay attention, all right? All these other YouTubers right now are doing their own little specials, all right? Nobody streams at our time. Now, all of a sudden, everybody over here in our time zone, with the cameras on, taking all of our viewers. So I say this to you. First of all, don't leave. Second of all, go and tell everyone else at the other channels to get your ass over here, man. Y'all need to go over there and recruit them, like we're doing a Mormon, neighborhood walk. You know, you got your white shirts on, and you're knocking at doors, like, bring them over here, man. And then also hit that damn thumbs up button so we can get this thing going. Thank you. That's what I got.
We ready?
We ready.
All right. So, you remember all the fact checkers? Anytime someone would post something on Facebook or Twitter, there would be a little thing, fact checkers, right? Independent fact checkers. They would label something as not true, something as true.
How do you get that job anyways? I'm curious.
That's a good question. So, the White House, the White House tweeted, seniors are getting the biggest increase in the Social Security checks in 10 years through President Biden's leadership, to which Twitter itself fact-checked and said, seniors will receive a large Social Security benefit increase due to the annual cost of living adjustment, which is based on the inflation rate. And then update, White House.
The White House got fact-checked?
Yes. Update, the White House has now deleted their fact-check tweet. Elon is a savage, bro. This dude.
That's funny, bro.
Yeah, that was pretty funny. So yeah, even the White House is getting fact-checked. But look, we have a lot to cover today. We're going to cover the press conference. We're obviously going to cover the rate hike. We have some charts to show you. We have two possible scenarios of what could happen moving forward. And I dove deep into the FOMC well of knowledge. And I did some doxing of these members who give votes on the FOMC. I have a breakdown for you guys, and I'm excited to share that. But first, we're going to take a look at what the markets are doing. So, Robin,
Que pasa?
take it away.
All right. So getting right into it, we are going to. Sorry about that, Rocco. We're going to look at Bitcoin coming in at $20,484.94. So we are in the trade sideways at 20K zone that we've been at for the last week, slightly above where we were for the last few months. And we are in anticipation for the release of the Fed rate, 0.75. I think there's not enough discussion on the impacts of these rate hikes. We are seeing that there's less loans. Here, I got actually an article here. I'm just going to jump right ahead. Wells Fargo mortgage staff braces for layoffs as U.S. loan volumes collapse. Also, J.P. Morgan Chase is talking about massive layoffs as well when it comes to their firm because of a lack of volume, a lack of people taking out loans. Obviously, nobody wants to take out a loan. And we're in a situation right now where people are actually favoring, and I don't even blame them, a fixed rate mortgage. Would you like to lock in a mortgage at 8%? For the next 30 years.
Yeah, sure.
No,
won't be alive.
That's what I'm saying. So we're all kind of in agreement, right? The Fed is going to pivot at some point. And if even worst case scenario, it takes a year, right? But at least in a year from now, you could get a better rate on your mortgage. So people are taking out fixed rate mortgages. Home sales are down by 10%. Well,
not only that, but the mass cancellations of new construction homes
is crazy. All right, so taking another look at the broader markets here on crypto side, ETH still over 1500 at 1560. You got XRP at 46 cents, Cardano under 40 cents at 39. Still a great buy here, guys. Anyways, NFTs are thriving there on Cardano. And they have the Hydra is one of their next upgrades coming out, which is going to increase throughput dramatically. And then Crypto Fear and Greed Index just coming in right at the same 30 as we were. I think everything's going to be kind of flat. It doesn't matter where it is, with the exception of some small alts, like quite up 10%. Look at that. And then
was that VMix? VMix token?
Yes, VMix token, yes. And then you got on the day,
this is
kind of neutral, yeah. So we're gonna get a ton of volatility on this in 18 minutes, man.
The VIX is already up to 2.67%. So
yeah, so we got some articles. We don't know how many we're gonna get through. As soon as this goes live, the Fed meeting or the press conference, Jerome Powell. Everyone's expecting 0.75%. That's kind of a foregone conclusion. The question is what is the narrative going to be coming out of it? What is Jerome Powell saying, hey, inflation's still too high. We need to get down to 2-3%. We're going to stay the course. We're not going to pivot at all. Like, we don't care if we destroy the economy. That's kind of what he said at Jackson Hole and at the last press conference. And that didn't fare very well. And you know what? He has all the running room to stay that kind of narrative, to stay hawkish. And the reason being, well, we had the labor numbers came out yesterday, and there's 2 jobs for every 1 person. Rounding up, by the way. It's like 1 point something. But
1.9.
Essentially, the job market's strong. The economy is still holding strong. Obviously we're down from our all-time highs, but still GDP is going up. The economy in general is looking good. And so with that said, there's if Jerome Powell wants to come out and drop the hammer again like he has been, he's all systems a go. Green lights. Now, at the same time, we are going into a recession. There are looming issues when it comes to layoffs. And, there's a temperature in the room. And I feel that a change in sentiment is coming. And I think that we could hear, or that we probably will hear, a shift in the narrative that because at some point you can't just keep raising rates.
Yeah,
and we're getting to the threshold.
They're going to have to.
At some point, we're getting to a threshold where you're going to crash the economy. Not recession. I'm talking about crash the economy.
Not just the U.S. economy. Global economy.
And so, you know, are they aware enough and smart enough to see, or proactive enough to identify that they're at the teetering breaking point, and that maybe it is time to at least show the narrative that, hey, these rate hikes are coming to an end, or at least as dramatic. You know, like if you were to say, hey, you know what, we have a target 4.5% because this will put them at 4%, then like that, you're like, okay, cool. That kind of leads them into the path of 0.5 next hike, and then pretty much a pause afterwards. I think 4.5 was a consensus in the past of a target range that they wanted to be at by the end of the year. And so, I don't know. What do you think?
I think the number is irrelevant, right? It's going to be 75. Even if it's 100, I think it's a little irrelevant.
We're not going to go down this rabbit hole again, but
we don't have enough time.
Yeah.
But what's a key is what Robin said. Watch the tone. Watch where he points to. The Fed is going to go next. And that's what's important. I do have a couple charts I want to show you, which these charts we're going to come back to after the rate hike is announced, and more so after the press conference as well. So the first chart I want to show you guys, this is the NASDAQ on the 1 hour. We have formed the head and shoulders and have broken below the neckline. We should see our target range for the NASDAQ if this pattern follows through. We did see the depth of the head coming in right around 4%, which if we take from the top of the neckline and we measure the same 4%, we should see a price target for the NASDAQ of around 10,300 and call it $10,400. So about another 2 to 3% to go. And then moving over to the Dow Jones, a bullish pattern. This is on the 30-minute. If I hide this bull flag here and I throw on the Bollinger Bands, you can kind of see some volatility that we should be expecting to see coming into the next 30 minutes. But classic bull flag. We did break out of that pattern, came right back in, got resistance at this top trend line, have broken out currently. So we'll see. Maybe something got leaked. I don't know. Definitely going to keep an eye on it. All right. I want to get into, there's a few things outside of the Fed that I want to talk about. And the first big piece of news, what are your thoughts on MoneyGram?
Oh, man. They partnered with Stellar. They were going to partner with XRP.
No, you mean they partnered with...
They did partner with XRP before, and then...
They were going to do XLM.
They announced a partnership, and then they backed out.
Yeah,
after the SEC lawsuit. And then Stellar Lumens, which is the biggest competitor as far as what the chain does.
Or nah.
They swooped in. And so one of the largest payment remittance and cross-border transfer, obviously ton of volume.
You know how many daily monthly users they have?
Yeah, a ton of volume coming from Latin countries.
You know how many daily monthly users they have? Or active monthly users? 150 million.
Jeez.
That's a lot of people. They will now allow U.S. customers to trade and hold Bitcoin, ETH, and Litecoin, sourced from Be in Crypto. Money transfer service MoneyGram has launched a new peer-to-peer service on its app to enable customers to buy, sell, and hold Bitcoin, ETH, and Litecoin. They will roll out the service to U.S. customers in D.C. and all U.S. states, not including New York, Idaho, Hawaii. CoinMe will provide the backend support for MoneyGram's new service, and they will expand offerings of other cryptos on the app in 2023. Some of the other cryptos they're talking about is Dogecoin, Matic, and Cardano. Now, I don't use MoneyGram. I don't think I've ever used MoneyGram. You might not use MoneyGram, but 150 million people a month use MoneyGram. And so as adoption grows, and the idea is to have crypto services like buying and selling and holding in every large app every large remittance service there is out there. That way we get adoption to grow at a faster speed. Again, we might not use it, but a lot of people across the world use it. So this is big news. You got any thoughts on this?
Yeah, man. So first of all, big win for CoinMe, man. And so CoinMe is basically the exchange that is just running on MoneyGram. So the order books, the liquidity, all of that influx of money and liquidity is going into CoinMe. Are you familiar with CoinMe? I've heard of it. I've never used it. I've never even seen it. I don't even know what their interface looks like.
Same.
But obviously, I think that maybe they, with this partnership, they're probably going to skyrocket, bro. They're probably going to shoot up to one of the top exchanges. I mean, why not? I mean, here's the thing. Like,
I mean, MoneyGram is big, but they're not. They're not.
MoneyGram is
MoneyGram is big.
MoneyGram is huge, bro. I mean, look. You want to look up how much money moves through MoneyGram. You might think 150 million users, but as far as how much money is actually money. Let me see here. MoneyGram. Yeah, we'll look it up here in a second, but. Anyways, man. So then there's that. Also, don't forget that all of these transactions, all of the wallets, so you execute the trade on CoinMe, but this is all done on the Stellar network. So we're finally seeing what is happening with the with this partnership. So one, if you buy and you buy crypto, you remove it, you bring it over to a Stellar wallet. And so now the Stellar wallet is powering this. The exchange is providing the liquidity, and MoneyGram is giving you the users. Giant partnership. I'm telling you, this should be a bigger story than it is. Should be way bigger. Watch out. Watch out. And we got no pump. We got no pump from Stellar. And so these are the things, these partnerships, this is what companies are doing in the bear market. And Stellar Lumens right now is number 25 on the coin market cap list, right at 10 cents, down for the day, down for the week. So no movement with this announcement. And you have to really look into the nuts and bolts of this partnership to even see their name. And so it's kind of like in the fine print. Oh, hey, by the way, we're using Stellar to move all your money. So pretty huge.
It is pretty huge. You know what else is pretty huge?
¿Qué pasa?
XRP.
What?
New partnerships.
What?
Ripple helps bring new euro-pegged stablecoin to the XRP ledger. This is sourced from Daily Hodl. The team behind the largest euro-backed stablecoin is announcing integration with the XRP ledger, also known as XRPL. This next statement is a quote from the Stasis CEO, Gregory Klumov. Stasis is the company that is doing the stablecoin. Quote, another brick has just been added into the foundation of yours, which is the name of their stablecoin, and it will solidify our asset for the next cycle of stablecoin market adoption. Our ongoing partnership will focus on exploring the newly emerged opportunities of XRP to enable a better financial inclusion, as well as stablecoin infrastructure and services that truly align with the values of the Web3 realm. They goes on to state that EURS is an Ethereum-based stablecoin that aims to remain pegged to the euro on a one-to-one basis. This is another quote from Stasis. We found XRPL to be the very blockchain rails that provide significant benefits such as advanced scalability, increased speed, and lower costs. Now, XRP and Ripple continue to make huge partnerships, even with this big SEC case looming. Imagine what's going to come its way when they don't have this lawsuit hanging over their head. I mean, can you imagine how many companies do you think are waiting on the sideline, waiting for this lawsuit to be over to hop on the XRP train?
This should say US-based stablecoin, Tether, US-based stablecoin, or United States-pegged stablecoin, dollar-pegged stablecoin. That's what it should say. And the only reason it doesn't is because of the hesitancy between the stablecoin issuers that are at front and center. BUSD, Tether, Circle. They're not touching at RippleNet right now. They're not touching XRP. And it's just simply because why take the risk and when there's a lawsuit looming? You know what I mean? Like, you don't want that spotlight on you.
That's what I'm saying.
But you're seeing exactly what would happen without that court case in Europe. Because obviously, the SEC doesn't have jurisdiction in Europe, and Europe probably doesn't care what the SEC thinks. And they might a little bit, but
of course they care what the SEC thinks.
But here's the thing.
I'm not saying they every decision they make.
But they're not ultimately, making their final decision off of that. And, the final decision I think was made with a lot of dollar peg stable coins. I think a lot of decisions were made like, hey man, everything's green light, everything's good to go. We can't because of this lawsuit. And I think, obviously outside of the US, a little different. Also, real quick, Big Chili Willie dropped us a $5 sticker earlier, so big shout out to you. Yep. Thank you so much. We do have a few new people in the chat as well. We got TA, Blue, Liam Crypto, Dave Digital, M, Mr. B, Suvesi, Roy, Corey, Lori, Ham Traders, Rocket Jr. Hola! Welcome to Sin City Crypto.
All right, let's move on. Elon makes the headline again, as he is to offer Twitter account verification as a subscription service. Now, we posted something about this on our Twitter yesterday. Users may soon be able to opt into a paid subscription service to have their Twitter accounts verified. The cost for verification may be $8 or more per month, as prices will be adjusted by country. It goes on to say, users willing to pay for verification will get priority in replies, mentions, and search. Will see half as many ads and have the ability to post longer video and audio files. Users who pay can also bypass paywalls for publishers willing to work with Twitter. Now, the people that are already blue checkmark, they were not very happy about this, because now anyone could pay $8 a month and be verified. But do you think this is a net positive? I mean, could this be something that could stop all these scams, all these bots, and everything that's kind of wrong with Twitter?
Yeah, I mean, obviously, if you got to pay for a check mark, you can't you can't have a bot create 10,000 accounts at $8. So simple, fixes it.
Yeah.
Now, if you waited 6 months and had to get X amount of followers, thousands and thousands of followers, and then, apply and bug and like try to know the right people to get your check, and then you finally got it. Yeah, you're going to be salty. Doesn't mean you can't spread the love though, man.
Are we going to pay $8 a month and get verified?
It's like, I'll pay $8 a month. Hell yeah. So,
you heard it here first. Robin's paying.
Yeah. I want to know is can we pay people to hit that damn like button, man?
What I want to know is
it doesn't work that way.
So we did since Crypto Muscle's in here.
What's going on?
Since Crypto Muscle's in here.
Oh, Crypto Muscle's in here.
We did receive a very cool gift from him yesterday. Rocco, go ahead and show your camera.
Of course.
Yeah, so where's the Rocco cam at?
Boom, right there.
Look Bam!
Look
So
at
we
this.
got a dope neon sign,
That
Sin
looks
City
great.
Crypto. So huge shout out, Crypto Muscle. Thank you, my friend. We appreciate it. We love it. So thank you so much again. Just super cool, man. That was cool. I love it.
Mm-hmm.
All right. So I did a breakdown, and I'm going to need you to do me a favor, Robin. I need you to pull up those two FOMC 2022, FOMC 2023. So I went ahead and I did some research. I'm like, all right, how exactly does voting work? Does it change? What's the basis of it? I found research. I found who the voters this year are and who the voters next year are, right? It changes every year. The Board of Governors, those stay the same unless they're moved out and someone new comes in. But what changes is the Federal Reserve charters. So, for example, this year, and if you're ready, Rob, you can throw it up there. So, for example, this year, you have Boston, Cleveland, St. Louis, KC, and New York. And I have this broken down, okay? So on the left is dovish, and if you're not familiar with this term, that means they're a little more lax. They're not so quick to jump into Fed rate hikes. They're more likely to pivot or want to pivot, right? So Michelle Bowman, Lael Brainerd, and Christopher Waller, they are board governors. And then you have Susan Collins, who is the Fed chair for Boston, Fed president, and Loretta Mester, who is the Fed president for Cleveland. On the more hawkish side, you have Lisa Cook, who is also a board of governors, and then Esther George from Kansas City, and James Bullard from St. Louis. And more on the neutral side, you have Jerome Powell, which is the chair, Michael Barr, Philip Jefferson, those are board of governors, and John Williams, seen as neutral to kind of hawkish, but we threw him in neutral. And he is from New York. And next year, and we're not going to show next year, but next year, New York is in it as well. So I did some research. So a couple things that stood out to me when I did some research on these guys. So Loretta Mester, who is considered very dovish, this is what she said, I believe a year ago. Quote, "It's important to augment our data and models to fit this current economy." So we talk about this all the time, how numbers come out, and if it's not to their liking, they'll change the words, and they'll change whatever. Did we get the numbers in, by the way? Someone said 0.75. They change the tone. They say, look, I know the numbers say this, but it's not really this. It's more like this. So she is one of those people.
0.75 rate hike. So this is the...
Yeah.
Here, I'll just pull this up here. So the highest since January 2008. I'm looking at this article for the first time. Oh, there's nothing there besides a title.
Yeah, you're going to get more during the press conference, which we will have the press conference live, so stick around.
All right, cool.
All right. So if you want to go back to that graphic, Robin, for me, thank you so much. So I want to show next year, right? Because we already know what's happening this year. We got 0.75, probably going to see 0.5 or another 0.75 next year. So, Rob, if you can throw that up there for 2023. And I want to show what's changing and who's taking their place and what their policy stances are. So as soon as that's up, beautiful. All right. So these are the voting members for 2023, okay? You have Patrick Harker, the Philadelphia president, Lori Logan from Dallas, and those are going to be on the dovish side. Hawkish, you have Charles Evans from Chicago, and Neil Kashkari, Minneapolis Fed president. I put an asterisk because the guy was a little more dovish about a year and a half ago, and which you'll see when I show you a video clip of him speaking just a few months ago. And now he's seen as more hawkish. And then on the more neutral side, again, you have the New York chair. So a couple things I have highlighted on some of these people that are voting next year, okay? So Charles Evans, this is what he said in 2014, okay? This is the Chicago Fed president. Before the Fed raises rates, we should have a great deal of confidence that we won't be forced to backtrack on our moves. We should be exceptionally patient in adjusting the stance of U.S. monetary policy, even to the point of allowing a modest overshooting of our inflation target to appropriately balance the risks of our policy objectives. He is considered hawkish. He was also advocating to bring inflation down at any cost, including rising unemployment, which a lot of the other board members are saying that would be a key indicator to stop the Fed rate hikes. Patrick Harker, who is seen as dovish from Philadelphia, he said in June of this year, quote, "I think we need to get to neutral. My estimate of neutral is 2.5% quickly, but we don't have to overdo it." So remember, these are people with voting power next year, okay? Moving on to Lori Logan from Dallas. She is seen as dovish. She was super aggressive with Treasury purchases during the pandemic, buying 1 month's worth in a day. In a day. She wasted zero time. She believes in the central bank being able to provide liquidity even in the most difficult economic conditions. So her stance is, doesn't matter, we're in a depression, a recession. If the Fed needs to turn the money printer on, we're going to turn the money printer on. And then the last thing I want to show is a 2-minute clip from Neil Kashkari, the Minneapolis Federal Reserve president. Okay, we're going to watch this, and then we're going to come back and we're going to talk about it. Okay, pay attention.
And when inflation started to take off, after the economy was reopening a year ago, I thought, and many of my colleagues thought, this is likely going to be a temporary effect. You know, we had the service sector of the U.S. economy shut down. Households had a lot of money because they've been saving money. There was a lot of transfers from the government in terms of fiscal stimulus. They were not able to spend that on restaurants or on travel. So that was getting spent on goods and products and washing machines. And you saw really high inflation in the goods sector. So what I thought was going to happen was that as the economy reopened, people would shift their spending away from goods towards services, and the economy would return more into a balance. That has not happened as quickly as I had expected, and you've seen prices climb and climb and climb. So in response to that, the Federal Reserve has moved very aggressively to say we have to do our part to to regain price stability and then get inflation back down to our 2% target. Now, what causes high inflation? High inflation is caused when there's a mismatch between supply and demand. If demand is outstripping supply, prices go up. People want goods, they want services.
All right. So you have a Federal Reserve president talking about, well, we didn't think that inflation was going to stick around because we thought, hey, people are locked into their homes. They're going to have all this money. They were spending on supply, not services, or they were spending on goods. And now we thought they were going to move into spending it on services, which was going to help on the goods side with the supply. Well, that didn't happen. There is also supply and demand that also relates to services, guys. No way. I don't know. What are your thoughts on everything I just broke down? What do you think about where we are now, where we're going to be moving by the end of the year, and then moving into next year?
Well, the Fed in its entirety, they tend to be delayed and pivot and move and make decisions until it's way too late. Obviously, the writing was on the wall with inflation 6 months before they raised a single rate. And so for me, it doesn't matter who's in there. What they're going to do is they're going to wait until this damn thing is too late. They're going to wait until the market absolutely tanks, until people are in distress, global economies are burning down, and then finally they're going to be like, oh, okay, yeah, we're going to ease up on this thing. But it's going to be way too late. They do it every single time. That's what they do. And so I don't see them changing course and all of a sudden being like this, have an epiphany like, hey, let's get ahead of this. Let's start easing up the interest rates now. Why not at this point? You're not going to bring, at 0.75, you're not going to bring down inflation this month. And if you do, the only way you're going to bring down inflation is by straight crashing the market. And if you came out and was like, look, man, we got to target 7%. We're going to bring it up in the next year and a half. 0.25 all the way across the board. Like, that's what we're doing. That's our game plan. Like, if they did that instead of just leaving question marks everywhere, I think we would have a better path forward to a better economic outcome. And I think the simple fact that it's just nobody knows what the hell they're doing. They don't even know what the hell they're doing. And when they figure out what they're going to do, it's going to be way too late. And you know what? Are we going to get another 75 basis points next month? I think at this point, who knows? Probably. My boy Anthony Barbacoa's up in here. How you doing?
I doubt it.
You doubted it last month?
Well, I'm doubting it.
It's been 75 basis points for the last four sessions. There's 50 basis points before that and 25 before that. Just if you gave an elementary school child, you gave somebody that knows nothing about economics, you were like, hey, what do you think the next number is going to be? It's going to be 0.25, and you got a multiple choice. 0.25, 0.5, 0.75, 0.75, 0.75, 0.75. What do you think their answer is going to be for the next one? I'm just saying that, and on top of that, The whole reason they're raising it is to lower inflation. Inflation ain't going down. It literally went down 0.2?
0.1.
0.1%. It went down 0.1. Let that sink in. Not 1%, not 0.5%, not 0.25%. 0.1% is what inflation went down. And they raised the interest rates 4 times at 0.75. And so you think the job is done? They're going to revert course and change all of a sudden? Like, no, the job ain't done. The system is broken. Inflation is broken. And you know what? Their whole model at trying to fix this is broken. But you know what? They're dead set on continuing until inflation goes down. And inflation ain't going down. So at this point, I expect 75 basis points next month. I think it's coming. At minimum is 0.5. And even then, that's still crippling.
It's just frustrating because we should never have been put in this situation, right? They should have started raising interest rates, and Jerome Powell did this, okay? He actually started doing this in 2018 until President Donald Trump called him into the office and said, hey, what the hell are you doing? The economy was booming, and he started to hike the interest rates up. Donald Trump called him into his office. Out of that meeting came, and they literally flipped course the very next month, the very next meeting. So what should have happened is if you're going to issue all these checks, right, all these stimulus checks, put money into people's accounts, right, people are pent up in their homes, they got all this extra money, they want to go spend it, you should have been hiking the rates up slowly then. You don't hike 75 points into a recession or while we're in a recession. You see it coming, and then you start doing it beforehand. That way, now, if our baseline was at, let's say, 1.5 to 2 coming into this year, we could have slowly turned the knob up, right? 25 points, 25 points, 25. Instead, it's like 75, 75, 75, 75. And so, and they're going to crash the global economy because of it. And what's interesting, though, is a couple of charts I want to show. So this is the 30-minute or 1 hour on the Dixie. It has kind of tanked down $110.76. The Dow Jones on the 30-minute, that has broken out of its bullish, the bull flag. It has retraced. It did get all the way up to 33,000, pulled back to 32,930. And then NASDAQ not really moving, kind of a spinning top candle we're seeing here. Same thing with Bitcoin. Decent candle. This might turn into a spinning top as well. A lot of indecision. We saw a initial pump, right? But this isn't the sharps. This isn't the smart money. The smart money, what they're waiting for is they're waiting for the press conference, right? Everyone knew 75 was coming. 75 was already priced in. But what's key, what's important is what is Jerome Powell going to say? There is literally going to be people who sit there and look at his body language and facial expressions and how he moves his body when he says certain words. And they're going to be breaking down his tone. They want any little inkling as to whether we are going to continue this hawkish sentiment with the Fed, if we're going to be at a pause, or if we're going to flip into more of a dovish Federal Reserve. And again, we are going to be showing that live. That's coming up in about the next, I believe, 15 or 18 minutes.
All right. I do have the White House is having a press conference right now, though, and they're getting asked about the Fed. So here, I don't know what they were saying, but I saw that they were going to reference a question. So let's just. You got my sound, Rocco? No, nothing. Oh, damn it.
She is such an idiot.
All right. Anyways, I'll get the sound booted up here in a second. So.
All right. So there's a couple of there's an article I want to share with you guys. It has to do with the Fed. So this is from Arcane Research, and their research shows that the crypto market might be on the verge of a reversal, and they give two possible scenarios in regards to the Federal Reserve. Source from Cointelegraph. Arcane Research senior analyst Vettel Lundi mapped out the direction of the that the market might take. This is a quote. The July 26th squeeze saw a daily high-low variation of 15% as markets hastily moved up, whereas the October 25th and 26th moves saw daily high-low variations of 5 and 6% respectively. Further, momentum has stopped, indicating that traders should brace for longer consolidation. Here is their scenario number 1. Jerome Powell remains astute in combating inflation and prepares the market for further hikes. In this environment, I expect correlations between Bitcoin and other asset classes to remain elevated and the now 4.5-month-long trading range to hold firm, with dampened activity leading to a longer-lasting opportune environment to stack Satoshis. Scenario 2. Jerome Powell provides subtle pivot hints. In this scenario, I see the correlated market environment softening. Last week, we saw how unique structural crypto-related market activity caused correlations to decline through a substantial short squeeze. Pivot anticipations will lead to similar reactions and revitalize Bitcoin's digital gold narrative. Out of these scenarios, which one is more likely? And do you agree with what they're saying, how the markets are going to play out with each scenario?
I think each one holds on its own. I think it's just kind of like you have no idea what they're going to do. I think the number, what was that, number 2? What was that one again?
Pivot.
The pivot. I think that's more likely, but here's the thing. What do you consider pivot?
Hey, we're going to stop.
Okay, so I don't think they're going to reversal, but yeah, I think a pivot as far as at some point they're going to stop, and I think that within the next 3 to 4 months, I think they will. I think they're going to go full steam ahead, locomotive style, break stuff, 0.75, 0.5, do that for the next 3 meetings, and then they're gonna absolutely break things, and then there's gonna be some other economic asterisk that pops up. Some other country is gonna be doing something stupid, and then all of a sudden the Fed is gonna be like, hey, you know what? Because of this situation, obviously because the markets are going to be just straight destroyed, the economy is going to be destroyed. I think at that point, they're going to use some world geopolitical global event. They're going to use that as the narrative to shut it down and stop raising interest rates. Now, I don't think they're going to reverse anytime soon. At least not until inflation at least comes down. Sub 4%.
A lot of people are saying the tone of Jerome Powell in this press conference is going to be a little more dovish, right? Midterm elections are like 4 days away, 4 or 5 days away. Do you think he cares, right? I mean, you got to remember, he was appointed by a Republican president and was kept by a Democrat president. So the Federal Reserve has no relation to the White House. They're not regulated by anyone. They're their own entity. They don't report to the U.S. government. They don't report to Congress. They're their own separate entity. So do you think that's even on his mind? Does he even care how his words and what he does and says will impact the midterm elections?
I think at this point, no.
If
they were going to reverse course to change the election, I think they would have done it before. But then again, maybe this is all part of the grand plan. Maybe this is all part of the big news, or the big narrative was, hey, let's tank the economy so that way we can flip the House and Senate, right? But newsflash, they didn't tank the economy.
Sort of role in that, and what?
Let's take a look. I have the stream here pulled up. Let's take a look at what Miss Karine Jean-François, whatever.
In your view, with the sort of stalemate that's emerged in the larger nuclear talks.
So I don't have anything to share on that particular IAEA
Yeah, she only had
visit.
one question on
So
inflation.
clearly that's something that we recommend. We welcome, I should say, not recommend.
I honestly think. Are people really overbuying? Are people really over purchasing things right now? I mean, that's the whole point of hiking interest rates, is to dampen demand. But like when it's demand for groceries, people have to buy groceries. So is raising interest rates, is it really doing anything to help inflation? Is it?
No.
So then what should they do? I honestly think this is out of the Fed's control. I really, really do. The whole point, again, of hiking interest rates is to curb demand to let supply catch up. The problem is the demand is for stuff we need to survive. Gasoline, food, rent, mortgage, barbecue sauce.
You leave that sweet baby Ray's out of this.
I'm just saying, dude, it's like, what's the Fed going to do? What's the Fed? Fed needs to do this. Fed can't do shit about supply chain. And that is literally what is broken, is the average cost of stuff that we need every single day, stuff that is not a luxury, that is a necessity. You're making everything more expensive for businesses. And in turn, what are they going to do? They're going to pass that down along to the consumer. It's just it's like a death trap we're in, like this never ending circle of crap. And it's like we have no one that's out there, whether in the Fed, whether in the commerce, whether in the Securities and Exchange Commission, wherever the hell they may be across all government entities. No one knows what the hell to do. We had a valiant effort by our president to do the Inflation Reduction Act, which reduced
Print more
nothing.
money. Yeah, okay.
I don't know. It's just frustrating, man. It's frustrating. And we have it good here in the U.S. We have it good. It's other countries, emerging economies, that are taking the brunt of the hit based off of what we're doing here. So, yeah. Got anything else to add to this before I move on?
No.
Bitcoin's not doing anything exciting, by the way. It's still had a decent candle at 20,700. Dixie is still down at 110. NASDAQ pumped a little bit, not too much. Kind of broke here. We'll look at the NASDAQ chart real quick. So NASDAQ broke below the neckline, but it did break above. The important thing here, this is on the 1 hour chart, by the way, is we want to make support on top of this neckline. If we don't, we should see a move lower to the 10,500. But again, guys, Jerome Powell's speech is what's going to move the markets. Whether this trend's going to continue and it's going to keep shooting up and test this 11,130, or whether it's going to come down and test this $10,300, $10,400 level, that remains to be seen. Same thing with Bitcoin. I had this parallel channel drawn. This is on the 1 hour chart. And more inside this channel, we do have a kind of a symmetrical triangle. Did break out above, but we wicked all the way up to 20,726. We are currently trading at 20,600. So I feel like stagnant a little. Big volume on this move, by the way. But again, the Fed minutes, not the Fed minutes. The Fed press conference, when he comes, that is when we're going to see big moves in the market. All right. Before we move on, or before we bring in the press conference, which is not ready yet.
I do have, they did announce, or they have some changes. Here, I'll just show you.
Oh. Changes to the apps.
Oh, well, it's, apparently my thing is frozen, so. Oh, never mind. So much for that.
Fail from Robin today on two ends. Huh?
Yeah, my laptop's not very friendly today.
And maybe you should lose yours and buy a new one.
Oh.
Yeah. Oh, God. All right.
Actually, I think I got it now.
All right.
Here we go. Let's try. There we go. All right. So I got the... So the 10-year Treasury yield falls by below 4%, and the Fed signals a potential policy change when it comes to Treasuries. Just to show you where we're at now, the 2-year and the 10-year are getting, the gap is widening. And so, you know, this inversion or this flip, generally, you're supposed to get more yield for the longer you hold a bond. So obviously, if I let you borrow, money, or if I borrow money, you're supposed to get a better deal on a longer term. So 4% 10-year falls under 4% now officially, and the 2-year still at 4.4. So
what you guys got to understand is, like, this was the safe haven place to put money during recessions, was Treasury securities. It is the only thing financial advisors can label risk-free across every single investment there is. The only thing they can say is risk-free is Treasury securities. That includes Treasury bonds, Treasury notes, Treasury bills. And when you can't even put it in there because you're getting 4%, on the back end, inflation is 8%. So you can't even keep up with inflation. What are you putting your money in now during a recession that's going to beat out inflation at 8%? That is the dilemma, the conundrum these financial advisors are in. People that are in, you know, it was my father-in-law's birthday last night, and he just retired about 8 months ago. He had a substantial amount of money. He said over the last 6 months, he is down 25%. And I was like, well, did you not talk to your financial advisor? He goes, I did, but where do you want to put the money? It's like, at this point, where are we going to take the least amount of losses? And, you know, the whole idea of some of these hedge funds and money market managers, right, money managers, is even during recessions, they want to get you a positive rate of return. And we're in a point now where everyone across every sector, every age group, retirees, workers, their investment portfolios are taking a hit. And if that's something, you couple that with the cost of living going higher. And some people, I have friends that have had to draw on their 401ks to be able to offset the higher cost of groceries, higher cost of gasoline. When you look at your portfolio and you're down 30, 40%, what are you left with? Yeah. I don't know. What else you got, Rob?
Well, you got your 30-year mortgage is over 7% now. Or I don't know if it's actually average over 7%, but last week it was 6.95, so basically 7%. And so with another 75 basis points, you're going to be inching closer to 8%. 8%. Let that sink in. I remember doing the show. I was on BitBoys around the blockchain, and I remember saying 8 to 9% is where if we keep the trajectory that we're at, 8-9% is probably where we're going to end up at on a 30-year mortgage. And you know what? There was some people that were just like, yo, this dude, he's got backwards hat. He don't know what the hell he's talking about. He's a freaking yo boy, whatever. I mean, just over here just clowning. Talking about 8-9%. LOL. This guy's a clown. It's funny how time
you are a little clowny. Just getting the meeting ready here.
That's some nice music right there.
Yeah.
That was beautiful.
That was from the Federal Reserve YouTube channel. 172,000 subscribers. Guys, help us beat out the Federal Reserve YouTube channel. We're only 170,000 away.
Real quick, since we got a little downtime before then, let's give a couple quick shout outs. We have Mash the Likes, Digital Woody, Doug Shmood, and Mike Minay. Hola! Welcome to Sin City Crypto. Guys, what do you think? Type in the chat. What do you guys think is on the table for the next Fed rate hike? Do you think it's 0.75? Do you think it's 0.5? Do you think it's the dreaded 1%? Do you think it's a complete halt? I want to know, what do you guys think? Because I know what David thinks, and he's delusional. I know what I think, and I'm inspirational. And I'd like to know what you guys think. Where are you guys at? Put that in the chat. What do you think the next rate hike is going to be? Now, once again, we want to know, what is the narrative that's going to be, what is the coming narrative for the press conference? Are we going to get a dovish Jerome Powell? Because I think he's going to say, my opinion, I think he's going to be like, yo, the job is not done. Inflation is still high. We're staying the course. We're going to break the economy. Skeezy says 0.75. Gunner, Oda! He says 0.5. Broke Yoshi says 0.75. So right now, Talk says 2 basis points. So that's 50. So yeah, Rocket Jr. 0.75.
2 basis points.
Yeah, that's 50. Right? No.
Well, 2 basis
20%.
Points would mean
so 0.25.
0.02. A quarter? You guys think it's going to be a quarter? No way, dude.
You know,
It won't be less than half, in my opinion. I don't think it's going to be less than half.
You don't think it's gonna be
We'll
less
see.
than- Yeah, no. I think it's either 0.5 or 0.75.
Bring on the
Barring
negatives.
an Black Swan event. Now, if
We might get a, but here's the thing: we might get a
China-
we might get a white swan event. We might have Russia pull out of Ukraine. We might have something like. I'm telling you guys, if Russia pulls out of Ukraine and that entire conflict is gone, 100% chance that within 6 months that happening, the Fed will start reducing the rates again. Like that is literally one of the biggest causes for inflation. So yeah, we'll see. Crypto Trucker said, I think they should tear the Band-Aid off and do 2%. Bro, you want to see the world economy in Armageddon? People robbing other people because they can't afford anything? I don't think anyone wants to see that.
yeah, because here's the thing: you also got to think with these Fed rate interest rate hikes. You have, it's not just homes; it's also credit card interest. If you go to buy a car, don't be surprised. You go to the car dealership, they're like, yeah, it was 10%. You know what? If there's a big demand for cars, and which some of the high-end cars.
Oh, here we go.
trucks-
Let's go.
You got it. All right. And bring us in on the side so we can get the reactions.
Yep.
We're gonna talk about it.
Good afternoon.
Hit that like button.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
I wonder if he really looks forward to the questions.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lag effects that you mentioned?
So a couple of things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions.
It's now at
as we make that assessment.
2,600. It's falling back down to here.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question, we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick?
Nick Cimarosa, The Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
The bond market liquidity
follow up.
issues and whether the Fed would turn the printers back on.
What is your best assessment or the staff's best assessment right now of the current rate of underlying
They
inflation?
also said that
I don't have a specific
he
number
also
for you there.
referenced
There are many,
reducing
many
the balance
models,
sheet, and
that look at
they
that.
significantly
One way
reduced
to
the
Well,
balance
here's what they're
sheet.
doing. They're not selling any of them. They're just not
When
re-upping.
inflation runs,
So
But
they're
no,
letting.
he said he opened up first sentence was we dramatically or significantly reduced the balance sheet.
Yes,
So
by
I think
not
that's what
rebuying.
models would.
They're just
No,
letting them fall
reduce
off the
doesn't-
balance sheet.
I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
Hi, John. Thanksgiving's gonna be expensive this year.
Hi, Chair Powell.
Good
Thank
luck
you for
finding
taking our
the time.
questions. Gina Smiley, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is it not already?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly
This question's not really. So, as of right now, I would say more hawkish than dovish, right? Based on his answers.
The only thing I heard that was on the up and up, the only thing I heard that was somewhat positive was that overall inflation is trending downward on the long term. He referenced PCE being up. He referenced strong labor market. The one damning thing I think he said was that the salary was a median salary or earnings or gross earnings, whatever the term he used. Basically, how much people are making at their jobs was up significantly. And so,
but that's not going to help inflation, though.
That's what I'm saying. That's what I'm saying. That's extremely negative. And so if you want to bring down inflation, see the problem with like a positive feedback loop is that if inflation gets so high that employers are forced to raise rates because people can't pay rent, for example, they're paying their employees more, then in turn they're just inflating the system as it is. Because if everybody across the country gets paid more and median salary goes up by 20%, then there's 20% more spending going on or more money. And then in turn, companies are going to raise their prices up by 20%. And then the employers do it again, and then they do it again. And that's how you get this runaway inflation.
Here's the thing to remember, though, guys. They don't just do that right away. They usually wait a few months and then slowly bring the increases. So they front the money, and then on the back end, they collect everything from the consumer. So,
no, I'm talking about the pay, how much an employee gets paid.
Yeah, and then I'm talking about what effect that has on prices. It is delayed. It does take a while. Right here, turn this up. Something about loosening policy.
Into restrictive territory. As we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't. Of course, we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
He literally
he just
wiped out trillions.
As you look around the economy,
the
clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies.
Premature. He's basically saying,
in terms of labor market.
You think we're going to pause? Like, hell no. Hell no, we ain't going to pause. That's literally what he just said in political white man speech.
At all worried that you're crimping housing supply in ways that
I want to hear this question
down the road.
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Victoria.
Let's see what the next question is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now.
As long as unemployment is high, wages are high.
We thought we would get that back.
They're good. They're not going to slow down, bro.
You mentioned wages, so
I mean, he literally said it. He was like, "It is premature to think we're going to pause."
With average hourly earnings, you see. So I would call it.
Anyways,
he said extremely premature.
Well above the level that would be consistent over time.
Only thing I heard was that inflation on the long term was coming down. I think we're gonna kind of end it here. Taking a look at what the markets are doing, just to give you an insight. We got NASDAQ down 1.52% right now. Dow Jones flipped. Everything was here in the green at the beginning of this meeting when they announced the 0.75 as expected. When things go as expected, the markets react positively. When you get what's not expected, like Jerome Powell staying extremely hawkish, which is what we just got. I think a lot of people were expecting a narrative where, hey, a reverse is coming soon. We're doing a good job, patting ourselves on the back. That did not happen. He literally was like, "Yo, labor's strong, wages are high. We got a lot of room to tighten this bolt up."
No, he was like, "Hair long, money long. Me and inflation don't get along."
That's right. And then taking a look, Bitcoin did shoot up as high as 20,800, I think it was, and it is on the downward as well. Let me see that chart you had pulled up.
This?
Yeah.
NASDAQ.
That's NASDAQ?
Dow Jones.
Gee, Dow Jones, huh?
30-minute chart on Dow Jones. Yeah.
You got a chart on Bitcoin? What's it look like over there? Because,
see, that's...
You got giant candles there. Giant wicks on both sides, huh?
That is the longest-legged doji I have seen in a while. So dojis typically are indecision in markets, and it's happening at a very key level. This lower bound of this parallel channel here.
A giant red candle next to that giant green candle. That's interesting.
Yeah. So you have big move for the bulls, big move for the bears. Now there's indecision. So it's important to see how this candle will play out. And there's still 2.5 minutes left. Yeah. But the Dow, the NASDAQ is still up. Believe it or not, NASDAQ is still moving up. And the Dixie is moving up as well. Do you remember this candle was red? Do you remember this candle was completely red?
That's the DXY?
It flipped green. Yeah. Super volatile. If we take a look at, if I take a peek at the VIX right here. So let's check the U.S. Volatility Index. And just so you can see, that is up 1.2%. Obviously, a lot of big moves happening, a lot of liquidations, a lot of buying, a lot of selling. So, yeah. But we are going to wrap this sucker up.
Yeah, let's get out of here. We've only got 80 people in here.
Yeah.
Everybody left. Where y'all go?
No, don't leave me. Just kidding. We are going to be uploading our afternoon video here in the next hour or so. Make sure you check out for that. But otherwise, Rocco, friends, family, friends of family, and family of friends, we thank you so much for joining us. Thank you to everyone in the chat. We love you guys. We'll see you tomorrow on behalf of myself, Robin, and Rocco. Tomorrow, 10:30 a.m. Vegas time. We'll see you then. Peace.